Hello, my name is Leslie Katona. I'm a Canadian mutual funds representative, brokering mutual funds and exchange-traded funds through Peak Investment Services, Inc. I'm also a life insurance agent with the Horizon Group, and I'm a chartered professional accountant. I have years of experience in the financial services industry. My goals for this video and future videos are simple. I'm hoping to make investing easier to understand, and I'm hoping to help you avoid mistakes that I've seen investors make. The video today is a brief look at equity and bond markets. Future topics may include investment philosophies, investment principles, diversification, just to name three. So let's get going. Equity markets. What does the term mean when you hear equity markets? Well, it means that there are stock exchanges, marketplaces, where buyers and sellers meet to trade stock. What's a stock? In the olden days, now it's electronic, you used to receive a piece of paper that would say you owned a certain percentage, more often than not a tiny percentage of a company. And it would allow you to vote for management directors, etc., etc. You had a tiny interest in a company. How is price determined for that stock? Well, there are many variables, from the financial health of that company, to the industry in which it operates, to the region in which it operates, to the country or countries in which it operates, to fiscal policy at the federal government level, monetary policy at the central bank level, investor expectations, just to name a few. There are many, many variables. So as you can tell, price is a complicated operation, and prices are not linear. They can be in certain cases, but for the most part, prices are not linear. They don't go up in a nice straight line. They can go up rapidly, they can fall rapidly, they can fluctuate within a range. There's a lot of volatility and a lot of risk. So if you have a short-term investment window, you need less risk. If you have a long-term investment window, you can tolerate more risk. And in general, for a long-term view, you should have some equity in your portfolio so that your portfolio will increase in value. Now, volatility and risk can be to your advantage. I know of a person who had invested $300,000 in March of 2009 at a time when markets were at their lowest point after the financial crisis that began in September of 2008. This person did not listen to the doomsday sayers, invested, and that portfolio today is worth at least 4 or 5-fold more than it was in the beginning. Let's look at bond markets. Generally speaking, bonds are safer and less volatile than equity markets, but not always. Bonds are very sensitive to interest rates. What's a bond, first of all? It's a debt that a company owes to you, the holder of the bond, and that company agrees to pay you amount of interest up until the maturity of that debt. It's very interest rate sensitive. If interest rates are low, bond prices are high. If interest rates are high, bond prices are low. 2022 was a bad year for bonds because interest rates went from being very low to very high. So there's also volatility in the bond market. How do you mitigate volatility in equity and bond markets. One word: diversification, which will be a topic of another video, basically a mix of stock and bonds. That's it for today. I hope you found this video useful. Please leave any comments or suggestions in the comments box. Thank you very much. Do take care. Bye-bye.